This is the World Financial Report on Radio with Harold Siegel. My name is Randy Marshall. Joining us via the telephone, our financial expert, Harold Siegel. We're taping the show on August 26th, 2011 at 8:40 in the morning Mountain, 10:40 Eastern. Our radio show runs on AM 640 in Toronto, 630 CHED in Edmonton. Harold's website is HESradio.com. If you ever miss a radio show, would like to listen to it again, go back on Harold's website, HESradio.com. All the shows are archived there. It was a crazy week. We saw gold over $1,900. We saw a pullback due to profit taking and a correction too. And it was a week where it's very unsettling because, as Harold will explain, Ben Bernanke came out today in Jackson Hole, Wyoming, and really didn't give the market what they were looking for, and that is a hint of quantitative easing 3. And Harold, I think one of the things that you've said for years and years, as gold goes higher, we will see a lot of volatility in the markets, and that's something people have to be prepared for.
You better believe it, Randy. Again, volatility is certainly what we're seeing in the markets, but there's no way that the markets are going to hit the levels that we believe it's going to hit if they're not volatile. The thing is that if you're going to buy gold and silver, you got to buy it physically. You don't want to be heavily leveraged in the market because you see what happens. These huge swings in the market will just knock you out of the market. People that bought silver back at $4 and are sitting in the market without heavy leverage and trading in the futures market have realized gigantic profits. The same in gold and silver. When we first started the show 10 years ago, gold was at $250. It's now at $1,900. Silver was at $4. It hit $50 back at the end of April and is trading right now at about $40, $41. There's a reason why gold and silver are doing this. The world economy is in shambles. In Europe, you've got countries going bankrupt. You've got Italy, Spain, Portugal. Ireland is bankrupt. So many more countries are on the verge of bankruptcy. And let's face it, the biggest economy in the world, the United States, is on the verge of collapse. They owe $15 trillion to China, and there's no way in the world that they're going to be able to pay back that money. So you're going to see volatility in the market, and we certainly saw it this week. You saw gold do what it should be doing, hitting record prices like it's done almost every single week. Gold hit $1,900, made a gigantic move. At the beginning of the year, gold was sitting at $1,250, and it hit $1,900 in the market, and the year is not even over yet. If that doesn't give you an indication as to what's happening worldwide, because back in the 90s, when the U.S. economy was strong, the U.S. dollar was strong, and the stock market was hitting record levels, gold was sitting at $250. There's no reason to own gold when the world economies are doing well. But it's the opposite now, and gold is telling you that there's major problems and it's going to go substantially higher. Now, what happened when gold hit $1,900 this week? They raised the margin requirements like they did on silver. Now, they didn't do it as severely. And that's why gold did not drop as much as silver had dropped at the beginning of May when silver hit $50 and then retraced to $32 in 4 days. To see the move that we saw in gold this week was typical of what should have happened. A market hit its record levels very quickly, pulled back on profit taking. They raised the margin requirements to get some of the smaller investors out of the market, and basically the market came right back again. As we're taping the show, gold's almost all the way back up to $1,800. There's no doubt in my mind that gold is going substantially higher. If you listen to the financial advisors, they're not bullish on gold. Wall Street is not bullish on gold. They're talking about bubbles. The fact is that there is no bubble in gold and silver because the general public is not involved in the market at this time. The general public always buys too late. What's caused the price of gold and silver to skyrocket and hit these record levels is the hedge funds, and that's where most of the money is going. That's why you're going to see tremendous volatility in these markets, because when they pull out, substantial positions out of the markets react to it. But there are other underlying factors in the market, and the thing that you really have to understand more than anything is that the trend is your friend. No matter what happens in the markets, when you see these abrupt pullbacks or major increases, the fact is that there's a trend involved, and that's what we basically isolated and chose 10 years ago. We saw that there was a trend coming back into the markets. I've been through the markets in 79 and 80 and saw what happened when inflation hits the market. We saw gold go from $35 in 1972 to $850 in 1980. There was a reason for it back then, and there's a reason for it now. We are heading into the worst financial times that we have ever seen. Most of us are not old enough to have gone through the Great Depression. And the fact is that this is the closest that we're going to come to that. As much as I hate to say so, and this is not something, that I'm excited about in any way, the fact is that what has been done by Wall Street and the government at this particular point, primarily due to greed and stupidity, has put us all into a horrible financial situation. And us being Canadian, but again, I'm living in the United States and talking about what's happening in the top economy in the world, that it's crumbling. When you owe $15 trillion, the United States cannot even pay the interest on that debt at this point. They have to print money in order to pay that debt. There's no way in the world it could be paid back. And the fact is that when you don't pay back a debt like this, bad things happen. And we are, again, going into 2012, and we're looking at one of the tightest and most frightening economies that you'll ever see. If you're sitting in paper assets like stocks and bonds at this particular point, you have very, very strong reason to be concerned. If I was sitting in stocks at this point, I would be having sleepless nights. If you talk to your stockbrokers, they never recommended gold to you back at $250. They're certainly not going to recommend gold to you at this point. However, gold hit record levels this week, and there's three things that you really have to remember. With everything that's confusing happening in the world markets right now, what's happening in Europe with the sovereign debt situation, what's happening in the United States where they can't pay their debt and everything bad is going on financially, there's three things that you really have to concentrate on. Number one is that the U.S. dollar is going to continue to drop, and we know that 100% for a fact because the Federal Reserve came out just a few weeks ago and said that they're not going to raise interest rates till for another 2 years. That means that the U.S. dollar will continue to free fall, and as the Federal Reserve continues to print and print and print more money to pay these ridiculous loans that the United States has at this point, right now 50 cents out of every dollar that the U.S. collects in tax revenue goes to pay the interest on the loans. By 2020, which is not that far away, 100%. So it's obvious that there's no way that the U.S. can ever pay back the money to China. As much as I hate to say so, and I really hate to talk about these type of situations, especially on the radio show, but if you look at how most of these horrible financial situations end, it ends in war. Back in the Depression days, during the 1929-30 period, when the U.S. went into depression, don't forget, that's where World War I started. So again, when the U.S. is in this type of financial situation, it's only a matter of time until they default on their loan. Right now, what they're going to do is just to continue to pay it by printing and printing and printing new money because there's no money coming into the coffers. The fact is that 70% of all the income from the United States comes from consumers, and the consumers are broke. They're out of money, they're not working, and their home values have plummeted so severely that they have no money left. So that's representative of the entire United States at this point. So three things, when you're investing, three things that you have to realize at this particular point, which are vital to clearing in your head what you really need to do. Forget about everything else, all the confusing factors, everything that everybody is telling you. What we've told you now for 10 years, for a decade now, is that the U.S. dollar is going to continue to fall, and we know it's going to do that for 2 years. That means that as the U.S. dollar continues to fall, gold and silver will continue to rise. It's an action-reaction type of situation. The U.S. dollar falls, gold goes up. It's happened forever. Second situation is obviously what's happening in the United States and in Europe is a major fear because, again, all of them are bankrupt. And seeing that all economies work off of each other, it's going to affect everybody. Even though the Canadian economy is one of the stronger economies, don't forget your neighbors, we're neighbors with the United States, and what happens there eventually affects our economy. So again, we've got to be very tight. You got to be very, very sharp in what you're doing and stay very basic on this. The other thing is inflation. There's inflation all over the world now. China has inflation up to about 7.5%, and they're raising their interest rates, is what you should do. On top of that, they're doing that. They did that in Canada. They're doing that in other areas, in Hong Kong. But the fact is that we have runaway inflation. And by the U.S. not acknowledging this and not raising interest rates like we should be, it's only prolonging the agony and make the situation even worse. So basically, when you have high inflation, high oil costs, high food costs, and people are not making as much money, that's what inflation is. Forget about what the statistics tell you and what the U.S. government is telling about inflation, because they exclude food and they exclude oil. Well, those are the two highest inflationary items in the world. So basically, as far as we're concerned, if we want to stay on the right ship and you want to stay in the right investments, you've got to realize that the U.S. dollar is going to continue to fall, which means gold and silver will continue to rise for at least 2 years. On top of that, these situations in Europe are not going away. They're bankrupt. You can't all of a sudden find financial euphoria just by snapping your fingers. This is a situation that's going to be intact for at least 5 to 10 years. So what we really need to do is we really need to hunker down. We need to realize that we're going into the worst possible economy that we have ever seen. And you don't want to speculate. You don't want to be heavily leveraged. You want to stay in the situation that we're in right now. We've been doing this radio show for 10 years. I've never, ever missed a radio show, and that's because Randy and I take this very seriously. We want our Canadian listeners to be in the right markets and do the right thing. First of all, it's about capital preservation. There's very little money being made in these markets right now. You can't put your money in the bank and make any money whatsoever because interest rates are at zero. What we need to do is we need to preserve our capital, number one, but if you're in the right markets, as we have been for the last 10 years, and our clients are making tons of money, it's a wonderful situation to be in, because as I've always said, 90% of the money is made by 10% of the people, and as long as we're in that 10%, I'm comfortable. We have no problem sleeping at night because we have no stocks. We've been buying gold, we've been buying silver, we've been buying diamonds, and those have proven to be the greatest assets and have been the markets that have returned the most amount of money and will continue to do so. We want to sit back for at least the next 5 years and let these markets continue to do their thing, because as far as gold and silver and diamonds go, they're going to react extremely heavily to inflation. For 2 years, the U.S. will not raise interest rates. That means that inflation will get to such a high level that we'll be at hyperinflation. You know, you've read stories and heard about people going to the grocery store with a wheelbarrow full of money to buy a loaf of bread. Don't think that those days are so far-fetched. Because, again, by not doing the right thing, which they should be doing right now, the Federal Reserve is raising interest rates, biting the bullet for the next 2 to 3 years like they did back in the Reagan days, and righting the ship. But they're not going to do that because they're so concerned about the almighty stock market and the real estate market, which is never going to recover for at least 5 to 6 years. What we need to do is be smart. Own physical metals. Don't heavily leverage anything. Don't speculate. Buy your gold, buy your silver, buy your diamonds, put them away. Another thing is, don't tell anybody how well you're doing. When people are not doing as well as you, they're not happy for you. We need to be quiet about what we're doing and just sit back for the next 5 years and let these markets do their thing. If the markets react the way that I anticipate that they will, we're going to be looking at $4,000 to $5,000 gold, and we're going to be looking at $200 silver, and we're looking at diamond prices 5 times what they are today. Again, we're going to go into 2012, the most difficult times we've ever seen. This is a time to be very sharp and to be very conservative. Don't speculate. Pay down your debts if you can do so. And again, continue to listen to this radio show. Get the newsletter this week. Randy did a phenomenal job. There is so much information out there, and he goes through it all, sifts through it, and finds the vital information that you need to make an intelligent business decision. So again, no matter what your financial advisors are telling you, they never told you to buy gold at $250. They never told you to buy silver at $4. They're certainly not going to tell you to buy it at this particular point. But if you don't own gold, silver, and diamonds going into these next 4 to 5 years, number one, you're going to be like everybody else. You're going to be stressed and trying to keep somehow ahead of inflation. But if you're in the right marketplace, the game plan is in the next 5 years, we can cash out of these markets with huge profits in gold, silver, and diamonds, and then if we get a repeat of 79 and 80, we'll see interest rates back up to 20% or higher. So imagine selling out of our hard assets that we made so much money in, being one of the 10% that made all this money, and then quietly putting our money away at 20, 25%. It sounds like a phenomenal game plan. We've been through it in 79 and 80. I believe the exact same thing is going to happen right now. So again, that's my strongest recommendations. Get into the gold and silver markets. We're going to talk about diamonds soon, one of the strongest investments you'll ever see. And again, as long as we're in the hard asset market, we're going to get through the most difficult times. And remember, The three things is that the U.S. and the European economies are on the verge of bankruptcy. The weak U.S. dollar we're guaranteed for at least 2 years, and we've got inflation. That's a recipe for higher prices in gold, silver, and diamonds.
As events around the world change daily, not only in the financial markets, but geopolitically, as we see over in Libya, and obviously we remember this year earlier, all the unrest in the Middle East in general, you need to use precious metals to profit and protect your wealth.